when history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply chain, really supply shocks from COVID and the war in Ukraine. And you will see, so sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting.
Ark Invest CEO Cathie Wood has had a huge start to the year with her flagship fund ARKK up 30% year to date thanks to the rise of AI and innovations made by her basket of exponential technology stocks. However, Cathie, ever the contrarian investor, believes that something bigger is going to fuel growth and adoption of her innovation-based platforms, specifically crypto and AI, and that thing is deflation. Whilst most economists and analysts are predicting high inflation to stick around for longer than most expect, Cathie is expecting deflation to come fast and hard. She argues that when we look back on this point in history, we will see a huge fall off from the high inflation numbers caused by the pandemic moving quickly into deflation. This is because technology and innovation is innately deflationary as advancements in artificial intelligence and robotics begin to replace thousands upon thousands of humans' jobs. Goods and services can be produced at scale at much lower prices. These lower prices can then be passed on to consumers. But why is deflation bullish for exponential technologies like crypto or Cathie Wood's innovation platforms? Well, it's because if we see sharp falls in inflation numbers, this signals to the Federal Reserve and central banks that they can lower interest rates and increase money printing to stimulate economies. When this happens, assets further out on the risk curve, crypto and technology, tend to outperform all other assets. In her latest interview with Bloomberg, Cathie breaks down her deflation thesis and also speaks on what investment moves she is making with the one exponential opportunity she sees is bigger than Bitcoin: artificial intelligence. Recently, Nvidia shares rose 30% in a single day when they provided higher than expected guidance due to increased demand coming from AI. Cathie has been historically extremely bullish on Nvidia for years, however sold out of her position in her main fund in January of this year. Here she breaks down why she sold out and why she's looking at other opportunities in the space. Before we delve into Cathie's latest outlook, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings report. These economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right. If you look at the digital world, gross domestic product that statistic was devised in the industrial age. We're in the digital age right now. Yeah. So we pay more attention to gross domestic income, which tends to be more accurate as we're seeing these inconsistencies. Very positive on NVIDIA. We have been very positive on NVIDIA. We bought it down when it hit nearly $100 in the fourth quarter last year. And then it tripled as some of our other AI-oriented stocks stood still. So, we're looking at, believe it or not, many people do not believe this about us, we're looking at relative valuations of names in the AI space. And we were looking at NVIDIA at 25 times sales, which is where it is. And Tesla, which is probably the biggest AI story out there, is at 6 times earnings. UiPath yesterday, not earnings, 6 times sales. UiPath yesterday reported it is a beautiful AI play. It too is at 6 times sales. And as far as NVIDIA goes, there are a few reasons we take some pause. It still meets our minimum hurdle rate of return, so 15% at a compound annual rate over 5 years. And so you'll see it in some of our more specialized portfolios. We're looking for the better values, but the risks to NVIDIA would include cyclical. When I hear shortages about GPUs or anything, I begin to think about the cyclicality of a group. Competition. Tesla is coming up with its own chip. Meta Platforms, Google, their own chips. For more specialized large language models. And then the tech itself, we're learning from Meta Platforms, the Llama model is able to do with less computing power, but more data. It's able to deliver better models. So there are puts and takes here. As people who understood the NVIDIA story, we were pounding the table on it on 2014, really till 2021. And many people actually put it into their own portfolios, and they may have held it. We have not gotten much pushback, and the reason is people know that we are on AI, but we're doing it in a little bit of a differentiated way. NVIDIA has become a check-the-box stock. That's why the valuation is where it is. But we are looking for those plays that have not only the vision from management team point of view and broad distribution, but also proprietary data and AI expertise. So we're just pivoting to another set of plays that most people have not discovered yet, much like they did not understand that NVIDIA was an AI play really until very recently. Well, for Google, ChatGPT was either the worst thing that has ever happened to it or maybe the best thing. We tend to think it's going to be disintermediated, though, by ChatGPT and other chatbots. So we're not going to need the kind of search and therefore advertising that drives Google's model. So we do worry about that one. And as you said, Apple, there are many people who think that even Amazon is going to be disrupted not only by social commerce, so people just shopping through Instagram and other social media sites, Pinterest, but it also could be disintermediated as if consumers use ChatGPT and other AI tools to say, I want exactly this kind of item at the cheapest price anywhere in the world. And it would go directly to that source. So, any platform that has served as, an intermediary is at risk, we would say. So Meta is interesting to us. We do like what it is doing. We love its sophistication and the fact that Mark Zuckerberg is now prioritizing artificial intelligence as opposed to the metaverse, which was really what he was focused on last year. So yes, we're interested in Meta's play here. We don't have it in the flagship portfolio. We do have it in other portfolios. If this cycle were to worry, we tend to think we're going to have a harder landing than most economists do. If the cycle were to hit it, and NVIDIA surprisingly gets hit very hard by cycles because the inventory buildups, and I would say we're in one of those right now, are so spectacular. If we have a combination of a correction and the recognition by the marketplace, perhaps, that some of these models don't have to be as large and don't need as much computing power as more companies use more specialized models. You get the confluence of a reality check. NVIDIA is just a very powerful company. They are so exquisitely positioned in the space, but you're paying for it now. The autonomous taxi network that we believe Tesla is building, it has more data. Talk about proprietary data. It has more data of real world driving miles than all of the other auto companies and technology companies like Waymo put together around the world, we would say, except for perhaps China, because we don't know exactly what's going on there. And we do believe that the autonomous taxi platform opportunity is a winner-take-most opportunity. The company that gets a person in an autonomous vehicle from point A to point B as quickly and safely as possible is probably going to get the lion's share of the market. And that company will, in the United States, we believe, be Tesla. And we believe globally that opportunity will scale from zero today to $8 to $10 trillion in revenues by 2030. So you can see why we're so excited by Tesla. It is the furthest advanced from an AI point of view, and it's even becoming a manufacturer of factories using artificial intelligence and becoming more and more and more efficient in manufacturing factories and cars. We think it's the most efficient in the world, right? And when history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply chain, really supply shocks from COVID and the war in Ukraine. And you will see, so sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting. We got GDI, which is the other side, so gross domestic income, which is the other side of gross domestic product. And they need to equal, but they're at a record gap right now. It's been negative, so in recession territory for the last 2 quarters. And I think many companies are going to feel a hard landing, and it's going to come both from units and prices. I think more and more companies are reporting this on their earnings reports. These economic statistics that take all the oxygen out of the room are hugely lagging, and they're not even getting it right. If you look at the digital world, gross domestic product that statistic was devised in the industrial age. We're in the digital age right now. So we pay more attention to gross domestic income, which tends to be more accurate as we're seeing these inconsistencies.
So there's Cathie Wood with her current outlook on markets and what moves she's making in the artificial intelligence space. Her deflation thesis does make a lot of sense too, with AI being exponentially adopted and companies already laying off thousands of workers in favor of artificial intelligence tools such as ChatGPT. The cost to produce goods and services is inevitably going to fall. On top of this is just the beginning. Imagine the reduction in costs when self-driving cars take all the jobs from Uber and taxi drivers around the world. AI and robotics are undoubtedly going to drop prices universally. The question is when. Anyway guys, what do you make of Cathie Wood's latest moves in artificial intelligence and her deflation thesis? Let me know in the comments. Hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, all the best.